Welcome back to the deep dive. So for months now, we've been really tracking this fundamental change in how global wealth is structured. And it all seems to revolve around one thing: real world assets, RWAs, and the transformative power of tokenization. We've gone pretty deep on the definition of an RWA, and we've even dissected the technical choreography of how you mint a token that represents something physical.
And today we're going to pivot. We're moving from the how to the why. Our mission in this deep dive is to get past the mechanics and really address the single most fundamental question: why do real world assets truly matter to you, whether you're an individual investor, a community leader, or a big institutional player?
Right.
What is this sort of enduring seismic shift that they actually represent?
Exactly, because this isn't just about a technical footnote in the blockchain world. We're exploring what we see as the three foundational killers that really define this RWA revolution. And these are concepts that have the potential to unlock, well, trillions in value.
They do.
We are talking about liquidity, accessibility, and the promise of what we're calling democratized finance.
And those three concepts, they really are the core reasons why tokenization has this genuine potential to, radically reshape our global interactions with money, with markets, and even the fundamental idea of ownership itself. It's not just about putting a title deed onto a decentralized ledger. It's about transforming that formerly static piece of paper into a dynamically tradable, fractional, and transparently governed financial instrument.
And crucially, we're going to keep this discussion grounded. We're going to keep it in the real world. We're talking about specific, tangible asset types that you interact with every day.
Yeah.
Things from, massive corporate debt packages and commercial buildings, all the way to the intellectual property rights behind a hit song, or even complex high-value carbon credits.
No.
So if you've ever felt like the exclusive world of high finance was this sort of difficult, high barrier to entry, gated club, this deep dive is really about understanding the infrastructure that is actively knocking those gates down.
And let's start with the most critical element. It's the essential foundation that everything else is built on. If tokenization is a high-performance vehicle, this element is the engine that drives the whole system.
And that engine is?
That engine is liquidity.
All right, defining liquidity. It's maybe the most important concept in all of finance. And for our listeners, let's just start with a quick test. Liquidity is really just the speed and the ease with which something can be converted into readily available cash.
Right, but without losing a significant chunk of its inherent value. That last part is key.
It's the key.
It's truly a spectrum, and I think understanding the spectrum is the key to understanding the whole RWA problem. On one end, you have your highly liquid assets: gold, cash, a highly traded S&P 500 stock, or a short-term U.S. Treasury bond.
Things you can sell instantly.
You click a button, the trade executes in milliseconds, and the cash settles almost right away. The transaction cost is it's minimal.
And then on the complete opposite end of that spectrum, you have the illiquid assets. The classic example is always a house or commercial real estate.
Oh, absolutely.
If you need to convert, say, a $5 million office building into cash, well, you're looking at an agonizing process. It involves appraisals, extensive due diligence, legal transfer of title, buyer financing hurdles, escrow periods.
And a closing that frequently stretches over weeks, often months, and sometimes, for really complex deals, it can be a year.
A whole year, yeah.
And that waiting period, all that inherent friction, that's where the value loss actually occurs. If you desperately need cash now, you often have to introduce what's called a distressed discount.
You have to slash the price.
You may be forced to slash the asking price by 5, 10, even 15% just to motivate a quick buyer. And that discount, that's the quantifiable cost of illiquidity. You're paying a massive penalty simply for speed.
So this is where tokenization comes in. It acts as the accelerator here. It takes those historically illiquid assets, and let's broaden the examples: physical property, massive private credit portfolios, venture capital stakes, or even unique fractionalized fine art pieces.
Right.
And it moves them onto these high-speed digital settlement rails.
But transformation is all about efficiency. These digital rails, they allow these assets to trade globally 24 hours a day, 7 days a week, 365 days a year. We're effectively applying stock market speed and continuous accessibility to assets that, before this, moved at the glacial, bureaucratic pace of traditional legal systems and, banking hours.
Okay, let's drill into one of those you mentioned, the private credit market.
Yeah.
Because that's an absolutely enormous and, frankly, notoriously opaque domain.
It's huge.
We're talking about a market measured in the tens of trillions of dollars globally. So a bank issues a major loan package, say debt financing for a mid-sized corporation. If that originating bank wants to sell off tranches of that loan to another institution or a fund, what happens traditionally?
Traditionally, it's a completely manual, relationship-driven process. It involves exhaustive bilateral negotiation, lawyers manually reviewing hundreds of pages of loan documents, proprietary data rooms, massive due diligence before the transfer is even finalized.
That's expensive.
It is. The whole process is opaque, expensive, and incredibly slow. And because of all that friction, secondary markets for private credit are, well, they're either extremely thin or they're just non-existent.
So how does tokenization change that friction for such a complex asset?
Well, if those loan tranches are tokenized, they are transformed into standardized, instantly verifiable, and divisible data packets. Each token intrinsically carries the embedded rights and obligations of the underlying debt.
So it's all baked in.
It's all baked in. They can be bought and sold on a secondary market the minute the loan is issued, often using DeFi protocols for instant settlement. And this doesn't just speed up the transfer, it creates a continuous, vibrant marketplace for debt where one simply didn't exist before, which fundamentally changes how risk is distributed, how debt is priced, and how capital is recycled in the economy.
Okay, that makes a ton of sense for the huge institutional players. But let's shift to the concept that is truly revolutionary for the individual learner. And that's the power of fractional liquidity.
Yes.
This concept, I think, is the key differentiator between, say, traditional securitization back in the 80s and 90s and what RWA tokenization is doing today.
That's a crucial distinction to make. Historically, if an office tower was valued at, let's say, $100 million, you needed a capital commitment pretty close to that amount to be an owner, or at least a very, very high minimum buy-in to a fund that owned it.
So your capital was just locked up.
If you held that entire asset, your capital was essentially imprisoned until you could find one single sophisticated buyer for the whole structure.
And that's a massive vulnerability.
It is. Tokenization allows for fractional ownership on a completely unprecedented scale. Imagine you hold tokens that represent, say, a tiny 0.5% stake in that $100 million rental building.
Yeah.
If you suddenly need, I don't know, $10,000 for an emergency or a sudden opportunity, you don't have to initiate the sale of the entire building. You don't have to wait months or plead with a fund manager.
You just sell your little piece.
You simply sell a fraction of your tokens, say 20% of your small stake in minutes, using that 247 global market we talked about.
Exactly. This instantly solves the problem of capital lockup at the individual investor level. So you're no longer reliant on finding that single whale buyer for the whole asset.
You're not. You're selling to a vast pool of global investors who only need to absorb a small, manageable fraction of the total value. The liquidity risk is effectively diffused and absorbed across the entire pool of token holders, rather than concentrating solely on the single asset owner.
Okay, I think we need to push back a little bit on the efficiency claim here, because this is where the complexity really lies. If an asset is highly fractionated, I'm talking, 10,000 different owners, and suddenly there's a market panic, can the system truly absorb massive token selling without a significant drop in value?
That's a critical point.
Is this fractional liquidity truly robust, or does it just create a new, faster kind of flash crash risk for physical assets?
It's a fair question. And the key difference between tokenization and, say, traditional thinly traded fractional schemes is the underlying market infrastructure. These RWA tokens are typically traded on robust, decentralized exchanges or highly regulated digital security platforms that are, they're designed for high volume. So while panic selling can affect any asset, the mere presence of a 247 secondary market drastically mitigates that distress discount we were talking about earlier.
So even if the price adjusts downward, the seller isn't forced to take that 10% penalty just to exit today, because the legal paperwork takes 3 months.
Exactly.
They can exit in minutes
Yeah.
at the current market price, which is far superior to being completely locked in.
Precisely. And this is why it translates directly into value preservation and, just as importantly, increased investment willingness. Liquidity is not just a convenience, it is an economic factor. As you established, illiquidity forces sellers to pay that penalty in distress.
Right.
The moment you introduce robust 24/7 high-speed liquidity, that systemic distress discount largely evaporates.
And the consequence of this efficiency is Well, it's profound. When investors, and I'm talking especially large institutional investors in corporate treasuries, when they know they can enter and exit a position reliably and quickly, more capital is willing to flow into these assets in the first place.
We see liquidity baked right into the valuation model. A $100 million office building that's tokenized and can be traded daily will inherently command a higher valuation, or at the very least attract capital more easily, than an identical building that takes 6 months to sell.
So the reduced risk is part of the value.
The reduced risk associated with capital lockup is a value add in itself.
And this new infrastructure allows for something called continuous price discovery. We're shifting from the old, sleepy world of periodic valuation to a dynamic, real-time assessment.
Yeah, think about traditional valuation. For complex assets, especially things like infrastructure or property, you might only get a formal appraisal every 2 years, maybe once a quarter if you're in a highly specialized fund.
And that valuation is manual, it's backward-looking, and it's immediately stale the second it's printed.
Exactly. It involves hiring appraisers, reviewing endless legal documents, assessing market rents, and calculating capitalization rates by hand. It's expensive and it's slow.
So how does tokenization change that?
When that asset is tokenized, every single fractional trade, no matter how small it is, contributes to a global, continuous, real-time valuation based on the supply and demand for those tokens trading 24/7. This ongoing market activity provides a powerful, updated price signal.
So what does that continuous price discovery actually mean for stakeholders beyond just the investor who wants to check their balance every day?
Well, it creates systemic advantages for major players. Take lenders, for instance. If a bank holds tokenized commercial real estate as collateral for a loan, they no longer have to rely on a year-old appraisal to manage their risk.
They can see the value in real time.
They have a verifiable up-to-the-minute valuation based on the market price of the tokens. They can manage margin requirements and calculate their exposure much more dynamically. This ability to instantly reassess collateral quality, it significantly reduces systemic risk in the entire lending ecosystem.
I can see the immediate value for risk management there, and for insurance companies too, I imagine. If they're underwriting title insurance or casualty policies on these assets, they can price that risk more accurately based on real-time market sentiment, not just old historical data points.
You're right. It injects market efficiency into historically manual risk processes.
And for the everyday investor, it just means transparent knowledge of their portfolio's value at all times. You're not waiting 6 months for a fund administrator to finally send you an annual or semi-annual report that may or may not reflect current market realities.
Right. It's a huge leap in transparency.
So liquidity is the foundation.
Right.
It transforms these slow, expensive, and sometimes impenetrable assets into globally accessible, dynamic market instruments.
The engine is running, and it's running 24/7.
Okay, that engine is powerful, but that power needs to be channeled somewhere. The infrastructure built by this liquidity engine is directly responsible for lowering the financial and geographical barriers to entry. So let's seamlessly move from liquidity, the engine that protects value, to how this engine lowers barriers for participants.
Yes.
That's the critical component of accessibility.
And historically, if you wanted exposure to the assets that truly build generational wealth, I'm talking private equity funds, high-end commercial property syndicates, complex structured debt products, or even blue-chip art, you face two immense hurdles.
Right.
And they formed this traditional gatekeeper model.
The first one, of course, is the sheer capital requirement, the big checks.
Exactly. You needed $100,000, $500,000, maybe more, depending on the asset class. But the second hurdle was often about status or, specialized knowledge. You had to be an accredited investor, which in many jurisdictions means having a net worth above a certain threshold or earning a specific high income. And these rules, while they were initially intended to protect small, unsophisticated retail investors from risky private deals, they ultimately resulted in the concentration of the highest performing asset classes in the hands of those who were already wealthy.
It created a self-reinforcing cycle of wealth concentration. Only the wealthy could access the high return, less volatile assets, which, ensured they remained wealthy.
Precisely.
Tokenization fundamentally disrupts this model by democratizing entry minimums.
Because we've already established that the asset can be frictionlessly fractionalized, the barrier to entry just shrinks instantly. Instead of needing that 5 or 6 figure minimum to buy into a specialized fund that owns a tiny sliver of, say, a portfolio of cell phone tower leases,
Right.
an investor can now buy a token representing that same income stream for potentially $50 or $100.
And that quantitative contrast is what really sticks in the mind of the learner. We are moving from minimums that exclude, 95% of the population, down to amounts that are manageable for anyone with a savings account.
And this immediately opens up entirely new categories of investment. Consider intellectual property royalties, specifically in music or film.
That's a good one.
Previously, owning a slice of the ongoing royalty stream from a catalog, like a major band's discography, that was only accessible to specialized investment funds. Now, those royalty streams can be tokenized, allowing everyday people to gain exposure to the recurring income generated by that IP for just a few $100s.
But I want to pause here, maybe introduce a little skeptical challenge. I hear the $100 story, and it sounds fantastic for fairness. But if the minimum is so low and the barriers are so completely removed, how do we prevent the market from being flooded with unsophisticated retail capital? Couldn't that increase systemic risk if an asset class collapses? Does removing the accreditation rules make the system less stable?
That's the core tension in democratized finance, and it's exactly why regulation remains so complex. However, the structure of tokenization itself provides layers of protection that aren't present in traditional, loosely regulated private deals.
How so?
Firstly, transparency is key. Because the asset's governance and revenue streams are governed by a smart contract on a public, auditable ledger, the fundamental risks are often much more visible than they are in an opaque, traditional private placement memorandum. And secondly, the underlying asset still dictates the risk. A tokenized U.S. Treasury bond or a prime commercial property remains a conservative asset, regardless of the size of the fractional slice you purchase. Tokenization doesn't eliminate risk. It eliminates friction and exclusivity.
That's a really clear distinction.
Okay.
So let's move beyond the capital minimums to the actual physical process of investing. We mentioned the massive reduction of friction, which we're calling the frictionless transaction rails.
Right. And historically, friction was the barrier. Think about trying to buy a piece of real estate overseas, even as part of a fund. You needed a symphony of intermediaries. Multiple international banks, local attorneys for title transfer, escrow agents operating in different time zones, custodians for the physical asset deed, and layers of administrative oversight. Each one adds time, cost, and complexity.
It's a nightmare.
It is. When the RWA is tokenized, the underlying blockchain technology dramatically cuts this bureaucracy. If the investor's compliance, their KYCML, is verified on-chain, they can complete the entire process from evaluating the asset's performance data, which is also on-chain, to transacting the purchase and receiving their token representation directly from their phone or their desktop wallet.
And the cost savings must be staggering.
They are. Legal and administrative fees, which can run into thousands or even tens of thousands of dollars on large private deals, are almost eliminated when the rules of ownership and transfer are automated by the smart contract. And those efficiency savings, critically, are passed on to the investors in the form of lower total expense ratios.
That cost-saving mechanism has to be a key factor driving institutional adoption, right? Because even a fractional improvement in yield over a massive portfolio that results in billions in savings.
Absolutely. And now let's explore the truly exciting social implications of accessibility. And that's the potential for expanding community wealth. This moves beyond just individual investment, and it facilitates collective action.
Okay, give us another tangible, non-real estate example of how this collective action can work at a local level.
Let's consider carbon credits or renewable energy infrastructure. A climate-focused community, or maybe a collective of small municipalities, they could pool relatively small amounts of capital, say $200 each, to jointly co-own a productive asset like a local geothermal plant or a specific forestry carbon offset project.
So in a traditional model, that geothermal plant would be owned by some distant multinational utility corporation, and the community would just be a customer. They'd pay their electricity bill.
Exactly. With tokenization, the token holders, the local residents, become the direct owners of the plant's production capacity and the corresponding revenue streams. They earn the yield, whether that's generated by selling power back to the grid or by the appreciation of the underlying asset.
And they get a say.
Furthermore, they gain direct governance over how that asset operates,
Yeah.
ensuring it aligns with local values.
So this shifts both the ownership and the dividend payments from a centralized top-down structure to a hyperlocal peer-to-peer structure. It's real economic empowerment, where the profits stay and circulate within the community that lives and works alongside the asset.
We can also look at supply chain financing. Small farmers or local manufacturers could collectively tokenize their accounts receivable, their outstanding invoices, to get immediate working capital from the community itself, bypassing slow, expensive bank loans and ensuring the local cash flow is maintained by local stakeholders.
And finally, accessibility transcends local geography through global inclusion. Tokenization just obliterates geographical barriers that have historically stifled capital flow.
Right. Imagine an individual investor living in a region with high financial volatility, maybe a country with strict currency controls, or just limited access to high-quality, stable assets. Historically, accessing something stable like U.S. Treasury bonds or premier institutional European real estate was, it was virtually impossible.
Why was that?
The cost of cross-border KYC, complex legal restrictions, prohibitive international transfer fees, it was just too difficult.
But if that asset is tokenized and lives on a globally accessible blockchain,
then that person in Southeast Asia or South America can invest in that US-based bond fund or that fractionalized piece of infrastructure with the same ease and the same low minimums as an investor sitting in London or Tokyo.
this is a fundamental correction of global capital inefficiency.
It is. It means that capital flows become more optimized globally, accessing the best, safest returns wherever they're found, regardless of the investor's physical location. And critically, it provides a stable, regulated investment avenue denominated in a secure currency for people who desperately need alternatives to their local market instability.
So accessibility is really about democratizing the minimums, eliminating the frictional costs of transacting, empowering local collective action, and crucially, erasing financial borders in the pursuit of stable investment.
It is the shift from an exclusive, localized financial system to a global, inclusive, and efficient one.
That is a necessary transition point. We've covered who can participate now, thanks to liquidity and accessibility. But participation isn't just passive, it involves rights and power. We need to talk about how the rules of engagement are defined and enforced in this new system.
Right.
This leads us directly to the third pillar, democratized finance.
When we talk about democratized finance, we're really discussing the ultimate culture shift in ownership. It's about taking control, decision-making authority, and fiduciary power away from the traditional centralized gatekeepers.
The property managers, the bank trustees, the corporate general partners.
All of them. And distributing it directly to the market participants, the token holders, who are the true stakeholders of the asset.
In the traditional system, your involvement was, well, highly limited. You invested your capital, you received a quarterly statement that often required a finance degree to even interpret, and you essentially delegated all your decision-making authority to a fund manager who operated under a trust us principle.
In the tokenized ecosystem, we utilize smart contracts as the immutable governing documents. And this is the radical part. The code literally becomes the law. Tokens are programmed to embed specific, verifiable rights, including voting power, and transparent rules for operational management and revenue sharing directly into the asset's digital representation.
Okay, let's get technical for a moment. If I buy a token representing a fractional piece of, say, a bond portfolio, what specific rights are we talking about that are enforced by code?
The standard rights would include defined voting power, which is usually one token equals one vote. It would define the frequency and mechanism of distribution and set rules for maintenance or liquidation. For example, the smart contract might stipulate that the token holders must vote on any potential refinancing of the bond or any sale of the underlying portfolio.
And it's all public.
This contract is publicly auditable, so every investor knows the exact rules before they invest a single dollar.
This transparency is the core element of auditable revenue sharing. So talk us through how the automation actually works, because this is where the trust really shifts from a person to an algorithm.
Let's use the tokenized rental property example again. The rental income is collected by a defined custodian, often an onshore special purpose vehicle or SPV that legally holds the asset. Then the funds are routed to the smart contract's treasury wallet. The contract is then programmed to automatically calculate the net profit after fixed expenses like property tax and insurance are paid, and distribute that rental income instantly and proportionally to all token holders.
So there is no human intermediary calculating the percentage splits or manually initiating thousands of individual payouts.
Exactly. And the critical transparency component here is the public ledger. Because all transactions and the smart contract logic are recorded in the blockchain, everyone sees the exact same rules, the same input data, the same mathematical calculation, and the same payout execution.
I see the immediate benefit there. If the contract dictates that, say, 90% of net profits must be distributed and 10% is reserved for future capital expenditures, every single fractional holder can verify on-chain that exactly 90% was distributed.
You verify the financial health. You do not merely trust the quarterly PDF statement that shows up in your email.
Right.
This verification process is really the engine of financial democracy. And this moves us into the complexity of stakeholder governance in practice, which determines the fate of the asset. In the traditional world, a single property manager or general partner decides if the asset needs major capital expenditure or if it's time to sell.
And that lack of influence is a huge frustration for passive investors. So if the roof on the tokenized building starts leaking, who decides if it's time to spend $1 million on repairs versus, deferring maintenance?
In a well-structured tokenized environment, the token holders, the thousands of fractional owners, can collectively vote on crucial operational decisions. This system often utilizes what's called a decentralized autonomous organization, or DAO, overlay. It applies decentralized liquid democracy directly to asset management.
What are the risks of that, though? I mean, if you have 10,000 retail investors, are they truly equipped to make complex, multi-million-dollar capital expenditure decisions? Wouldn't this just lead to chaos or constant indecision?
That's the challenge that has to be engineered into the governance mechanism itself. The DAO structure must be thoughtfully designed. For routine maintenance, the manager often has autonomy. But for major decisions like a $5 million renovation, switching lenders for a refinancing agreement, or the ultimate decision to sell the entire asset when a lucrative offer appears,
That goes to a vote.
that is punted to the token holders. And the rules often include sophisticated voting mechanisms like weighted voting based on holding size, or requiring a supermajority, say 66% instead of 51%, to pass critical measures.
So the ideological shift is profound. It's moving the decision power from a closed-door corporate board to the stakeholders themselves.
And the accountability is entirely decentralized. If the collective votes against a critical needed repair to save money today, and that leads to asset degradation tomorrow, the token holders bear that consequence directly through the loss of asset value. It compels active participation and educated decision-making.
And I imagine they have power over the manager, too.
Oh, absolutely. Token holders often have the right to vote on dismissing or replacing the external asset manager if performance is poor. This is a level of instantaneous accountability that is simply impossible in a traditional limited partnership structure that locks up capital and delegates all power for 5 to 10 years.
This whole cycle of verified rules, automated payouts, and decentralized decision-making, it brings us back to the core concept of transparency over trust. Tokenization replaces the reliance on opaque, quarterly black box statements with continuous, verifiable, and auditable information flows that live on the blockchain.
And this verification-based trust is absolutely essential for scaling this new financial democracy. Every single action, from the collection of rental income to the execution of a management vote, is logged, immutable, and publicly available for anyone to see.
So if an investor in Dubai wants to know the exact occupancy rate, or the recent utility costs, or the total reserve fund balance for the tokenized asset that's physically in Berlin,
They don't need to call a fund administrator, wait for an email, or rely on a third-party report. They can query the underlying data feeds attached to the asset's smart contract instantly.
And this level of verifiable transparency has to build regulatory confidence, which is vital for attracting massive institutional capital.
It's the key. If major pension funds or sovereign wealth funds are going to invest in tokenized products, they need to know that the governance rules are transparent, unbendable, and auditable, which blockchain provides uniquely.
So democratized finance isn't some naive aspiration. It's a security and efficiency upgrade. By distributing power and making every action verifiable, the system becomes more resilient, less susceptible to fraud, and ultimately more trustworthy than many traditional financial structures.
It creates a system where the asset manager's job shifts from being a black box operator to being a verifiable service provider who is accountable to the stakeholders.
That establishes a really robust and exciting framework for the future. But the critique is valid, and we need to ensure this is a realistic discussion. While the benefits are clear, we have to pivot now to the inevitable hurdles and potential pitfalls inherent in building a new system that bridges the digital and physical worlds.
It is absolutely crucial to maintain a realistic, even a cynical perspective here. Tokenized RWAs are not magic internet money.
Right.
They are digital representations of real, often complex, sometimes aging physical assets, and they are built on new, complex, and sometimes brittle digital infrastructure. The risks are substantial and they have to be addressed.
Okay, so the first set of challenges are purely technical and operational risks. They're tied to the code that governs everything we just discussed. When a smart contract is the governing document, any flaw can be catastrophic, especially when it's linked to high-value collateral.
The complexity of the smart contract logic is immense. It governs revenue distribution, voting mechanisms, and potentially collateral liquidation rules. The potential for bugs is not theoretical. It is a historical reality in the crypto space. A single coding error, a vulnerability like a reentrancy bug, or even a faulty external data feed, an Oracle failure, could potentially freeze, misallocate, or expose the underlying collateral.
I think we need to emphasize that Oracle problem here. A smart contract needs real-world data to operate. For example, the building's current occupancy rate, the local currency exchange rate to distribute dividends, or just the physical state of the asset.
Yeah.
If that data feed is corrupted or manipulated, or it simply goes offline, the smart contract, the engine of transparent finance, becomes blind, or even worse, actively malicious.
Precisely. If the Oracle feed that reports rental income is maliciously manipulated, the smart contract will automatically distribute fraudulent revenue and drain the treasury. So this introduces the concept of securing the data bridges, which is just as important as securing the code itself.
Okay, what's next?
Then there is the massive challenge of governance risk tied to physical assets. What happens when the thousands of token holders vote to sell the $50 million building, but the legal entity, the STV, is tied up in an 18-month bureaucratic process to finalize the sale? The digital world moves in minutes. The physical world moves at the speed of government bureaucracy.
That creates a massive discrepancy between digital liquidity and physical illiquidity. You can sell your tokens instantly, but the asset itself is still stuck.
Yeah.
So if the market prices your tokens based on a pending sale, and that sale falls through,
the entire market price collapses instantly, even though the underlying asset is still physically present and generating income. The solution requires sophisticated legal and operational wrappers that legally obligate the off-chain custodian to immediately follow the on-chain voting instructions, but those legal wrappers are expensive and subject to the jurisdiction where the asset actually resides.
And this brings us squarely to the hurdle of regulatory uncertainty.
Yeah.
This market is operating in a legal and regulatory environment that is, well, highly fragmented and actively evolving, which is just a polite way of saying it's unpredictable.
It is. The core conflict lies at the complex intersection of traditional real estate and securities law and novel blockchain jurisdiction. The central question for global institutions is, are these fractionalized tokens classified as securities? If they're traded globally, 247, which nation's regulatory body has ultimate jurisdiction?
That seems like a huge problem.
It's a major one. Consider the difference between the U.S. approach, where the SEC is still defining the regulatory perimeter, versus the European Union's markets in crypto assets, or MiCA regulation, which attempts to provide a clear, unified framework. This fragmentation means a tokenized building in Germany faces completely different compliance hurdles than a tokenized bond portfolio issued in New York.
So the legal bridge that ties the physical deed, which is regulated by traditional property law, to the digital token, which is regulated by potentially nascent crypto law, that has to be legally sound across multiple borders.
Yes. The failure of that legal bridge, if, for instance, a court rules that the token holder does not legally own the underlying fractional asset, makes the whole structure incredibly risky.
So what's the industry doing about it?
Yeah. The industry is spending billions to build these standardized legal structures, often using trusts, foundations, or SPVs in favorable jurisdictions like Liechtenstein or the Cayman Islands. But until major jurisdictions like the U.S. provide clear, unified frameworks for tokenized securities, the largest financial institutions will remain extremely cautious about mass adoption.
They can't risk it.
They cannot risk billions in fines due to future legislative changes.
And finally, we have to address the ultimate practical risk: the mechanics of dispute resolution and physical liquidation. We talked about governance, but what happens when things truly go wrong, like a default or a catastrophe?
Well, if a traditional bank forecloses on a $100 million building, the process is clear. They seize the asset, they sell it, and they recoup their losses. If that same building is held by a DAO with 50,000 token holders and the management defaults, how do you liquidate that asset and ensure a fair payout to everyone, including foreign investors, while adhering to local property laws?
The complexity of liquidating a physical, illiquid asset under the command of a decentralized global group of token holders that's arguably the single hardest operational problem RWA tokenization faces right now.
It is. It requires the legal framework to predefine every single step, ensuring the custodian can act quickly and decisively on behalf of the fragmented token holders in a crisis. The success of RWAs hinges on engineering solutions for these technical and legal risks, making the structures robust enough to withstand both a coding failure and a legal challenge in an international court.
But despite these significant and, very necessary hurdles, we have to conclude this segment by reaffirming the scale of the massive opportunity that compels this innovation in the first place.
This is not just some niche technological innovation, it's a global economic imperative. Tokenization is actively building necessary, compliant bridges between the old world of traditional finance, or TradFi, and the efficiency of blockchain infrastructure.
And the potential value that's locked up in previously illiquid or high-friction assets globally, including commercial real estate, massive portfolios of corporate debt, infrastructure projects, private equity stakes, that value is measured in the hundreds of trillions of dollars.
So if even a fraction of global commercial property, or a tiny fraction of the world's accounts receivable, moves on to these liquid, transparent, 247 tokenized rails, the efficiency gains, the unlocking of trapped capital, and the recycling of debt back into the economy will be, revolutionary.
Right.
This is the integration of the two worlds, and that is why this deep dive is so critically relevant today.
Indeed. It's a journey that's fraught with complexity, but the trajectory of modernization and efficiency is clear.
We've traveled across a vast landscape of financial modernization today, so let's bring this discussion to a final synthesis for you, the learner.
Real-world assets matter because they are the mechanism for financial modernization at scale. They create liquid, 247 markets where assets can be bought and sold instantly, protecting value by eliminating that distress discount and encouraging deep institutional investment.
They drastically increase accessibility by lowering financial barriers, turning those exclusive 5- and 6-figure minimums into manageable 3-figure slices, and they fundamentally remove geographical barriers, allowing opportunity and stable capital to flow globally, regardless of where the investor actually sits.
And crucially, they foster a truly democratized finance through transparent, verifiable governance. They shift the balance of power away from centralized, opaque gatekeepers and distribute that authority back to the active stakeholders via self-executing smart contracts and auditable voting mechanisms.
This is far more than a simple technological upgrade. It is a structural revolution in how ownership is defined, managed, and accessed. And it's moving us closer to a truly global, efficient, and inclusive financial system.
Now, as you integrate these concepts into your own understanding of global markets, we want to leave you with a personalized challenge, something to chew on as you reflect on this deep dive.
Ask yourself directly, looking at your own financial goals. What specific, historically opaque or illiquid real-world asset would you want to see tokenized first for your personal benefit? Maybe it's access to highly specialized alternative investments that were previously only for institutions.
And building on that community aspect we discussed in depth. Which local asset, a piece of infrastructure, a local business, or a community resource would you specifically tokenize to bring your neighbors, your peers, and your community members into co-ownership and collective yield? That question forces you to think about how this technology can be applied for tangible, local economic empowerment, not just abstract market efficiency.
The world of finance is changing rapidly, the barriers are falling, and the rules of engagement are actively being rewritten in transparent, verifiable code.
We urge you to stay informed, to remain curious, and to actively explore how tokenization is integrating itself into your personal and professional financial landscape. This future is being built today, and you are already a part of the foundational conversation.